Okay, we are back here, and we went to break in a flurry. Boy, we had to get to break. we got lost in the moment talking about where to take income. If you're just tuning in with us, of course, Phil Bloyd is here with Revolutionary Financial Group, helping walk us through, sometimes what might be a little bit of tough times for us financially. So the important thing, though, Phil, that I've learned from you is we make these adjustments, and even, adjustments like where you take income. Right. So on the front half, before we went to break, we were talking about, what does your emergency fund look like? And I know there are folks out there that really like to see a good bit in their emergency fund so that they don't, it makes them feel good, warm and fuzzy. But what if you're somebody who doesn't have the extra in your emergency fund to make those adjustments? Let's say you just have the required 6 months.
Yes.
Then what do you look at?
Let's look at bucket number one, behind curtain number one. Let's make a deal. So the first bucket we'll talk about after, say we're down to our 6 months expenses and we don't have the extra, so we have to take some out of our assets. I want to look at the capital gains bucket. Okay. So the capital gains bucket would be not a non-IRA, a typical brokerage account that's not an IRA, and maybe we have stocks and different things in there. So we have the opportunity to do some tax harvesting. We spoke about that in the past on some shows, but our tax harvesting would say, if I have a stock that is down in value, and maybe I have one that I've had for years and years and years, and I can offset some of the gains with the loss and then take a withdrawal out of that capital gain bucket at basically a zero tax.
Okay.
So that may be the next best place after the emergency fund, because I'm taking money, but I'm not paying any taxes on the withdrawal as I would on the IRA.
As you would on the IRA, okay. So you've kind of got your layers of priority here.
Yes.
So that's layer number two.
Yes.
Let's say we're stuck and we don't have that as an option.
Oh,
now what do we do?
Okay. Curtain number two, or bucket two.
Yeah, bucket two, curtain two, what's back there?
Bucket two, we have to, let's say we're over 72, we have to take money out, or we've already exhausted the other two opportunities, and now we're at the point we have to take money out of our IRA. So every dollar we take out of there is taxable. So the thing I'm going to look into next is, what are you invested in your IRA? Is there any way that we can adjust the expenses from your IRA? Quick example. Let's say I have an IRA and I'm managing it myself. Okay, what is your investment vehicle? Is it a fund? Is it an ETF, a mutual fund, or whatever? There are expenses involved there. So let's take a look at the expenses on those assets first. Let's see if we can switch that investment around, maybe get the same outcome that we're looking for, but maybe if we change the vehicle from mutual fund to exchange traded fund, or we get maybe an exchange traded fund that's much less in expense than the one we're in and has the same overall objective, or we go from a mutual fund, which may be higher in fees and expenses, to an exchange traded fund, same objective but much lower expenses. So we want to do that.
Okay, yep.
So we can get funds out, we're going to pay taxes, but we're losing less to expenses. Here's a big problem I wanted to talk about. We don't have a lot of time, but I'm going to try to get it in.
Okay.
A lot of people have done the 60-40 portfolio, meaning 60% in bonds, maybe 40% in equities, or vice versa. And they thought, well, by doing that, I'm in these bond funds, or I'm in these bond ETFs. So if the stocks go down, I can take money from the bonds. Well, the problem is the bond rates are really bad. So if I take money now from my bond ETF or my bond fund, I'm also going to be down 13 to 15%. So that's not a good option either. So if I need more money than the yield of these bonds or these bond funds, I'm going to take remember we used to have a term called a haircut.
Yes, taking a haircut. Yes,
I
remember that now. Yeah.
Okay, so on Wall Street, instead of saying loss, they say haircut. You know why?
because it sounds nicer?
Yes, you're learning.
Way rather have a haircut than a loss.
Absolutely.
Yeah.
Well, we don't want either. So, this is something we need to constantly be aware of. And the thing you need to do is you need to contact Rachel so that we can do that portfolio analysis.
Eye-opening, really eye-opening.
We can find those expenses.
Yeah.
We can look to lower those expenses. We can make sure that we don't have too much at risk. Now is the time.
Yeah, so make sure you do that because it's important to do, and you might be surprised what you uncover. Okay, we got another segment,
Yes.
so we're going to wrap it up after this break. We hope you stick around for our final segment on Lowcountry Money Talk. Stay with us.